The big banks have been summoned because regulators are concerned they're short-changing savers, and we can see the problem here. The purple line is the Bank of England base rate, up from almost 0 to 5% in 18 months. That's seen mortgage rates, the orange line, bolt up too. This is the two-year fixed rate, almost 6.5% now. Five-year fixes have just gone over 6% as well. But savings, down here in green, have dawdled by comparison. An average rate of just above 2.4% for instant access accounts. So this gap is an opportunity for banks to profit from savers and borrowers. Landlord David France is both.
With interest rates going up, we're getting hurt with the money that we borrow. And the money that's in the bank, we're not getting enough interest, and certainly not the appropriate interest which we feel we should be getting based on the rates going up on our debt.
For now, rate rises are benefiting savers more than they're costing mortgage holders. The orange line here is the increase in savings income in the last 18 months. That's nudging 25 billion extra in accounts. But the extra cost of mortgages is about half that, around 13 billion pounds. And that's because increased savings rates are felt instantly, while your mortgage payment depends on your deal. And almost 9 out of 10 mortgages are now fixed rates. Almost 60% of homeowners have 5-year fixes. That's the red here. A quarter, the blue, have up to 2 years left, which leaves just 12% the portion in green on floating rates, which are exposed immediately to rate rises. And that's a huge change from 7 years ago, when almost half of us had mortgage rates that were variable. And this matters because it's now taking longer for interest rates to squeeze the economy and thus bring down inflation. The Prime Minister agrees that's a problem.
You're right about the transmission mechanism being perhaps slower when it comes to mortgages than it has been in the past because of the preponderance of people to have at least short-term fixed-rate mortgages now, but that's something that the bank take into account in their modelling.
All of this will change in the next 18 months. Around 1.7 million fixed-rate deals will expire next year, leaving households paying an extra £2,900 on average. That's a wave of financial pain that increased saving is unlikely to offset.